But for the SPY, like I said in the morning brief, folks, if you look at the numbers here, so they closed the puts in the money, right? So I mean 26,000, right? 26,000 contracts that were open for the 598 puts yesterday. They closed them before the end of the day. So that's a huge reduction in the puts, folks booking profits. But we see them switching or other players coming in and buying calls out of the money. And that's why you see that gap higher that happened overnight. Now, what happens from this point on? I don't think you could, if you can try to move above 600 and kill those 30,000 contracts in the puts that are still in the money and cost about $3, so they still got some profits. They're probably closing as we speak, some of those, but you don't see them because this is not live data. Although the volume is updated once in a while, so it'll show up in an increase in volume. Now it's about 7,000, so you can assume, if you assume that all of them are closing, not just opening the 600 puts, which is kind of an extreme thing, but it tells you that at least 7,000 closed, you still have a big number here. So the market maker can decide to take that out and move above 600 to make sure that these guys lose. The problem is, what is the price that they have to pay? If you move above or to 600, you're going to be obligated to pay for the 598 calls. You're going to be obligated to pay for the 599 calls. And then there's a huge number, 142, almost 142,500 contracts open for the 600 calls. And that's a huge commitment. So I don't think they want to go to that zone and take the risk at 600. And this is why they're going to keep that as resistance. They're going to try to push the SPY down before it gets closer to that 600 zone, because there's a huge risk here on the calls side. And you're going to keep an eye on the TLT because, I mean, the majority of the improvement of the breadth is based on bonds going higher. So if we see the TLT reversing, and so far we haven't seen it reversing, right? It's trading along with the market with these gaps higher. So the market is following the path of the TLT. Now the TLT is weaker, but again, the market is going to be a little bit more stubborn. And SEC is stronger sign of reversal in the TLT. So that would be, we're getting really close to it, by the way. But it would be, for example, if we go back and close the gap here, that'll be 87.15. So if we go below that today, then that's going to be considered a reversal in the TLT. And you'll find it hard for the SPY or the Qs to move higher with bonds coming back down. So we'll keep an eye on the TLT. Bonds, once again, we talked about the TLT. The 30 is defending 4.8. So if it begins to move higher from this point on, forget it. The improvement of the breadth is not going to continue. On the 2-year, that's the optimism. That's more of the risk on IWM, Palantirs of the world, kind of the overvalued stuff, and less profitable companies. We're also seeing a rebound happening a little bit as we speak here in the 2-year. So maybe the downside is done and we begin to move higher. If that is the case, then the TLT will probably weaken, and it's going to lead the indices to weaken too, one step at a time. If you see Apple, for example, we looked at the options that they're buying, 232.5, and then you have the puts at 230. So yeah, I think that if we see Apple weakening, 3 minutes would not give you a good judgment. But if you look at the 15, for example, and you see, let's say, something like a bear flag kind of playing out, and we're beginning to take the lows of some of these candles in the 15 minutes, then that will tell you that Apple is going to weaken, and that might prompt the Qs to give you another trade on it. Of course, NVIDIA, got to watch that. It's important for the NASDAQ. I think it's more time than price is what matter in NVIDIA. As we progress in the day, if Apple weakens, we see NVIDIA joining. So you could have another trade here for the Qs, but hold your horses for now. You're done with the trade that you got. Let's wait and see. Hey, Mav, I got the Jan 31st FCX 40 money in the money calls. Is it the right move? Right now it is. Right now it is, because the dollar is going down, but don't overcommit. Because like I said, the moment the dollar rebounds, copper is not going to hold. So I get it. It's moving higher right now. We have earnings coming out. It makes sense. If you look at copper today, it's down about 2% though. So we have to be careful with that. So metals are not giving us a clear sign about what's going on in the dollar. Maybe platinum and palladium saying it goes down, but copper, silver say no, be careful. So don't overcommit here in FCX. You got the 31, you got the Jan 31 40 calls. 40 is okay for now, but let's identify a stop loss in the hourly just so you can be careful here. And I would say that the stop loss honestly becomes from the indicator. So if you look at the dollar and you see a rebound from this point on, look at what's going on right here, right? A little bit of a rebound in the hourly. So be careful with that. If the decline is stopped in the dollar, FCX will go down, and your call option is going to be out of the money. So don't overcommit. Spooky. Good morning, big dog. Thank you so much. Max Spain for the Qs 519. Why do we say 519 for the Qs? Let's see here. 3 minutes. 519. Let's check some of the numbers. It's mostly for the SPY really, but the Qs also matters. Some OpExes. Here, same phenomenon, right? They're closing the profits from the puts yesterday and bought some calls out of the money, so that's allowing the tape to go higher. I would say right now the max pain, you don't want to go below 520, right? Because that's going to have you obligated for 53,000 contracts on the 520. Although the volume is high today, so maybe they closed the majority of that, and that allows the path to drop a little below. Now, when it comes to the calls, though, 520 is also the highest number, so 520 is probably the sweet spot to close at. You don't want to go above, even though above you see massive contracts until 524 or 525, and no major change in OI. So there's not a lot of risk for the market maker to move the tape higher here. Not a lot of risk for the market maker to move it down either, unless you go to 516. That's far-fetched. So I think right now the sweet spot will be 520, because you ensure that these guys begin to close in the calls, and these guys right here begin to close their positions. Maybe they're achieving that already by parking the Qs here around the 520, just going back and forth above and below to make sure that these guys at the 520 begin to close. And then the market maker gets a clearer picture. Who's closing more than who? Are the puts closing the 500 or 520, excuse me? Are they closing more than the 520 calls? Right now, the volume suggests it is, right? So the volume becomes relevant in this kind of case. And if that is the case, then they probably move the tape higher after that. After they exercise the maximum pain, they push the tape higher. That's the assumption for now, but you have to watch the volume. It can't be definitive because we don't have the live data. We haven't reversed the trend because we haven't made a higher high yet. But are we threatening to do that? Yes, because we're above the 50 days moving average, which is important. Again, we've done false breaks above the 50 and then went down again, forming a lower high. So you'd look at this number as the ultimate confirmation. 599.70 could happen today. If it does, then yes, the answer would be no. You want to actually switch the calls. You want to go to the 605 for next week instead, and that'll make up for your loss in the spread in the puts. You can complement it if you still think that the puts are going to be viable, but I would think that if we go to 600, then 580 and below will be way too far. You're better off taking the trade out and swapping it with a shorter dated 605 calls. But one step at a time. The day's still young. You never know where we're gonna close here. COT shows biggest short positioning in silver of all time. Should silver being squeezed in a gigantic short covering move up? It ain't just silver, by the way. It's palladium also shorted heavily. So if you look at the SLV, for example, silver is shorted big time, but you also have palladium shorted too. Now, these guys are going to begin to work out, and you'll see explosive rallies in them. You'll see rallies like the VIX kind of chart. You'll see big pops in both palladium and silver. Even copper kind of shorted to a certain degree, but not as far as silver and palladium. But the spark for that to happen is the dollar. You got to reduce the dollar a little bit. You got to see a downtrend. And until that happens, I don't think that you should be going long silver in a big way or palladium yet. But if the dollar reverses from a weekly chart perspective and begins to head down, and let's say if we're adding the context together here, that VIX bet 60 for April, what if that's based on something systemic to happen? If we see that happening, beginning to happen, systemic risk, and then we see the dollar pulling back, you'll see huge squeezes in silver and palladium. And this is why I like to have them in my portfolio right now, just in case that happens, and I'll add to them in time. Keep adding to the position in palladium. I don't have silver, but I'll add palladium. Whatever one you want to pick. I don't like the music. Did you cut the PayPal trade? I wanted to enter yesterday, but because bears usually get if, I decided to wait in case today presented a better entry. Let's look at PayPal. Yeah, it's above 90, so that's a cut. I mean, it looks like it's going to close above. I don't know what's going to happen by the end of the day, but it looks like yesterday got a reversal, so why would you gap above? And now we have momentum turning positive. Yeah, I'll take it out. Maybe we'll stop at a certain point here, but I wouldn't go long either because you're going to have resistance really soon at 93.66. But the trade that we talked about, the idea of stopping at this line of 90 and then coming back and closing some of these gaps below. Yeah, it looks, who knows what's going to happen by the end of the day, but right now from a risk management, yeah, you don't want to enter it right now. Unless you go back below 90, then okay, we have a confirmation that we try to trade above, couldn't happen, we go down in the red below 90, that's going to open the trade back up. Because Spooky says, I have been watching the Meta 500 calendar spread. Buy the March, sell the February. It seems very far away, more than 15%. What is the thesis, narrative, earnings? It's an earnings pop. But again, as Small Family Office said, you catch the premium, right? And then you manage the trade after. That's the point of the Meta calendar spread. So here, let's go Meta. And remember, I want to enter a short, but I don't want to commit a lot of capital because I don't know if it's going to work out in my timetable or not. So I want to go with the 500, which will give me a 20% drop. We've seen those happen, by the way, in Meta when they don't perform in earnings. But since it is a little bit expensive, I want to complement it with a reduction in price. So this is why I sold the 500 for February 21st. That way I'm committing $200 for the trade to short 100 shares. And the beauty of this is, I mean, you have a 19% cushion and you have an earnings report coming out on the 29th. So suppose that the report is really bad and Meta drops 10%, for example, or 12% at that point. If that happens, we'll be trading at, let's say, the 537, 535, and the trade after that will be profitable, by the way. It'll be up about 200%, just holding it as it is. And by the expiration date of February, you might not cut below 500, and that expires worthless, and it leaves the 500 to play for March. So that's the idea. And again, if by March we go below 500, we'll probably just short at 500. If not, if we're close to 500 for 90, we're just going to book the puts from here. And they'll be handsomely profitable because if this is out of the picture and we go down to these levels of 519 or whatever, then you'll see the contract value moving from 450, 440 to 1200, 1300. So you'd make gigantic profits from just holding the puts alone. So that's the idea here. Now, at the same time, what if Meta goes higher? Right after the report? What if Meta lasts higher? In that case, we did not commit, let's say, $500,000 or $600,000 to short the stock. We're only committed $200 to short the stock. So it's, from a risk versus reward perspective, it's a really good strategy to enter a short in Meta. I don't like the music. Today was feeling like a bull trap for some reason, but seeing SPX over 6,000 tells me this market might go higher. A close above 6,000 will cause algorithmic buying, okay? So if we go above 6,000, you're probably going to see algorithmic buying. But there is a ceiling from the market maker perspective that they don't want to close above 600. Because even if we look at the SPX, which is not really relevant here for OpEX, but my hunch is you'd see a big number, right? Open interest 95,000. They probably don't want that to happen because you close above, now they have an obligation with those. And only 2,900 opened yesterday, so it's not a huge risk. They kind of accounted for it, but they'd love to also make these close below so they don't have an obligation to do anything. Below 6,000, so they kind of got the puts here, right? They got the puts today. They might also get the calls if they close below 600. At or below 6,000, excuse me, will do the job. So Tesla, I think it will be the most at risk because Tesla has an earnings report coming out. And from an investor's perspective, they're going to begin to worry about this report that's coming out. Let's see here, 29th. So we don't have a lot of time, 29th. So after the inauguration, you might see folks saying, okay, we got the inauguration. We didn't see a pop all the way to the highs, for example. So let me take some profits right here, de-risk a little bit before this report. And you might see Tesla is the one that's selling off more than Bitcoin. Because Bitcoin, maybe whoever is holding Bitcoin, they're still sitting at profits. It's a 60,000 plus commitment. It requires patience with the policy. But here we have a catalyst that could speed up the decision maker by the holders of the shares. So I think Tesla would be more at risk than Bitcoin. And we'll look, of course, at 427, how it's going to behave at 427. So if there's another rejection here at 427, that's not going to be a good look for Tesla because it'll be like the third, fourth time where it just failed to close above 427. In this case, you're going to go to the expiration date of the 31st, which will include the earnings report. You're probably going to do 500. Let's see what the 500 will give us here. 18%. Let's up it up to 20. So we'd sell the 510 and then sell the puts. Let's see here. We don't want to go below. Let's do 20. 20 is a little excessive. So we'll do 350 and then we sell the calls at 510. You net a credit of about $1,000 from this trade. And all what you need is Tesla moving up or down. You don't really care unless it goes above 510 or 350 by about $960 or 9.6. Let's call it 10. So if you go to 520 and above, that's a problem. 340 and below, that's a problem. And your margin is 5,100. I doubt it. I think they're going to charge you about 10, right? So 8 to 10, probably going to be this is kind of a low margin for a big trade like this. But look at the chance of profit is 81. So when you do a short strangle like this and you have a margin account and you know how to use it, you know how to manage your risk, you're putting yourself in the shoes of the market maker, where you say, I don't really give a shit where Tesla is going to go. I'm going to capture that credit in my pocket right away. So that's for the experienced trader to do that kind of moves. But if you're going to do the puts or the calls, I'd say let's wait till we get really close to this report right here before we make a move if there is no break one way or the other. Let's say it closed above 427, probably increases the risk to the upside. Close below 390 increases the risk to the downside. Good morning, Maverick Ryan. Thank you so much. Appreciate you. Sold the Tesla. 700 calls for Jan 26. Of course, of being cautious and have my SNL. Yeah, but you see, you're an experienced trader. Like you've been doing these moves for a while. The other traders, and I'm not trying to talk down to anybody here, but again, it's a margin account. It's a huge commitment. It could really blow up your account if you don't do it correctly. But if you're a shark, if you're a really good trader and you know what you're doing, you put yourself in the shoes of the market maker. Yeah, you'll go and sell the 600. You'll go sell the 250 in Tesla. Make sure that over 75 though. So actually sell the 200 here in Tesla, and it will sell the 600, if not even the 650, and you'll net a huge credit. And all of these moves require insane moves. So for the 650, it's going to require a 63% move. For the 200 puts, maybe a little more reasonable, but again, 56. Can the stock really lose or 50% of its value or gain 50% plus of its value in a year? I don't know about that. When you have a rally that's already went higher by adding $1 trillion to the company's valuation, I think that's a little far-fetched. So it becomes sort of a silver platter to net that credit. And if you can manage your margin requirement, I think you're good to go. Thanks, Mav. If you catch the VIX going up on a spike, does it make sense to immediately sell and short the VIX and ride it all the way down, depending on where the pop is? So here's the VIX. You don't want to look at the hourly pops, for example, but a pop like this, right? A pop like, you could have said the same thing here, right? The VIX went higher to 30 or whatever. Let's short the VIX and get out. But then you see a bigger pop after that. In time, you're going to be right. So shorting the VIX makes sense on the pops. If you have, let's say, longer than a month expiration, it'll work out usually. More than not, it'll work out. But usually, folks, in trading the VIX, the most lucrative part is to get it exactly right with the timing for both the pops and the drops. So a lot of folks speculate with the weekly options, and if they get it right, it scores big. But right now, I mean, you see this pop right here. It took a few days before it calmed down. And if you just bought the VIX puts with few days out, the market maker is already ahead of you and charging you an arm and a leg for that premium. So again, right now we don't see a pop. If we see one, for example, the 60, if we challenge these highs again, sure, yeah, of course I'm going to be shorting the VIX at that point. Is Apple too big to fail? It is too big to fail, and this upcoming report will be really critical because if Apple goes down, the weight is just too big. If you have Apple going down, let's say, I mean, it already went down here about 10%, and the market underperformed during that period because it was hard. You had to substitute the underperformance of Apple by NVIDIA going higher or the rest of the market working out in a big way. I think that if Apple breaks down another 10%, it's just going to be really hard to have Apple in a bear market, but the SPY and the Q is trading higher. I think Apple will go down for a reason and drag everything down with it. Now, as far as why are your calls working out for the 31st, because you got the 230, not far out of the money. You're actually in the money right now, and you got a gap higher today. So right now, I mean, you look at the 3 minutes, for example, you're making sort of a higher low, right? So keep it as it is. If you begin to trade down and take the lows, then you have to take it off, because be honest with you, right now, Apple, after a move like this, here's you maybe retracing the 100 a little bit, give it a little bit of time here to show up. So yeah, it might be retracing the 100, so you'll go all the way to 233, and then it heads down again, because when you see big red candles like this, they're usually followed with more pain to come. Next week's will be the 24th, right? So we'll do the 24th, switch the calls, buy the 600, and then sell the 605. Cost you about 200, but that's going to give you a little bit of an exposure that if we head higher and the 590 puts for February become far-fetched, at least you have a hedge here. Now, at the same time, you can just close the puts, because you could always re-enter them later. Let's see what the put's going to pay you here. Switch the puts, and let's do February. Yeah, you get about $500 worth of credit, so I'll take that. And depending on the close today, how we're going to trade, I'll probably go with next week's, once again, 605, and then buy the 600. Let's just see if we give it another week. Will it cost too much? Again, up to you. 215, 250, you're still going to have credit in your pocket from the puts that you sold, and you're going to have exposure to the upside. And then if we have a reversal, if let's say the SPY comes next week and, it was just OpEX or inauguration optimism and down we go again, you could always re-enter the 590 puts once again. So this is what I would do by the end of the day, folks, if you have that trade. You can, by the way, if this is like too much of a commitment here, you can do the 600, 605, 610. That way it costs you a half of the price, right? So you're doing a butterfly now. Buy the 600, sell the 605 2 to 1, and then buy the 610 calls as a hedge. Cost you about 113. Honestly, it will cost you about $1 without the commission if you do this. And you'll have good exposure for profitability. You can make 200, 300%. Let's call it 100 to 200. That'll be satisfactory to me. I'm watching the DAX and the FTSE. They did all-time highs yesterday and today. So probably we could see another all-time high in the SPY before the correction. What about the level 61, 16 on the SPX? Look, if you're going to track the European market, I'd say you're better off going with the Dow Jones, right? Because the Dow Jones, if the reason why we see European markets going higher is bond yields are pulling back. So if bond yields are going to pull back, who's going to be the biggest benefactor? The big tech names that will have earnings concerns. That's what the SPY is dominated by and the Qs is dominated by. Or is it going to be the Dow Jones, which is more dominated by the dividend paying stocks, or the RSP? So maybe you're better off buying the Dow Jones at this point. Maybe you're better off buying the RSP, not the SPY. Because the SPY, if you have Apple going weak or Nvidia going weak, it's going to limit those gains. So, and you're going to go with the SPX, going to spend a little bit of money. So I'd rather go with the Dow Jones, to be honest with you. Nvidia's a little hot today, but who knows? It could weaken at any moment based on the fluctuation of news. JCC 7078, good morning, Maverick. Thank you for everything you do. Thoughts on the Dixie and ALB entering? No worries about getting late here, but let's do the Dixie and ALB. Hey, look, I like lithium plays. I've been saying for you folks, you got to have some lithium exposure, whichever one you like. You like the EVs, go with the EVs. I told you Revion is a good choice. I have Revion bought here. The 15 now, but we also sold the covered calls, so reduced the entry price below. Now we're back in the money, and we have the inverse in the shoulder. I'll probably be adding, if we close above, let's see, 15 and a half, excuse me. If we close above that, I'll be adding to Revion. QuantumScape, I also have that, and QuantumScape could heat up as we see more and more demand for lithium. And I think that ALB is the more, let's say, direct play for lithium futures. So I'll probably add ALB too, but ALB is really, really volatile depending on the dollar. See, it did here an inverse on the shoulder and failed. Now it's kind of doing a reversal, a bullish reversal. So let's give it the benefit of the doubt. See how this earnings report will look like on February 12th, Wednesday. And if the dollar pulls back, you put two and two together, you got to go along ALB. Dividend, let's see here. The dividend here is 1.7. That's not bad. But I mean, you see the EV plays, folks. They weaken when the market is not doing pretty good, but then they heat up pretty fast. So even NEO today is up about 5%. So I'll continue to add these names, folks, the EV names. ALB is one on my list, of course. Mav, the IV is too high for UAL for puts next week. Obviously entering today. Okay, so let's look at UAL. The puts are high because market makers anticipating a big move. So UAL, forget about the butterfly, take it out right here. 21st, let's see, Jan 21st, that's going to be the report, Tuesday. So actually you'll be closed the 20th, then you come back and right away you have the report coming out after the close. So here, I mean, you look at the calls, yeah, they're pretty expensive. Implied volatility at 90. If you go with the puts, let's see if the implied volatility is higher. So this is how you measure where the market maker is thinking, right? So let's go 110, 6.4, right? 6.4 to break even, and the implied volatility is 93. Keep that in mind. So let's do a similar move here. 6.6, that's close enough. 105, implied volatility 94. So slightly toward the puts than the calls, but the market maker is anticipating a big move. How do you participate in this? Look, at the end of the day, you might be just wasting your money if you're betting on one outcome versus the other. Of course, I'm betting to the downside that they're going to live up to this rally, but who knows? Problem is, if you go all in, you overcommit to this trade, and then you don't get the outcome that you want, you'll be dead right away. There's no chance to repair. There's no chance to fix. So just keep that in mind, that you don't want to overcommit in this kind of investment betting on an earnings outcome. Now, if you have February 21st, as I got, right, I have February, I have puts for February, so I'm not worried about what the report is going to do. I'm looking beyond that a few weeks. But if you're going to do the earnings play, you probably want to do, I mean, the only thing you can do really is some spreads. So you can do 105. I wouldn't go below 105, to be honest with you. At 95, you're still spending a lot. 300 to make, let's see here, delta's minus 25. Yeah, it's a little too expensive. And the gamma is kind of low for this delta. So anyways, you see that the profit is okay, but again, it's too costly. So how do we mitigate this? You can do a calendar spread for next week. So the report comes out in the week of the 24th. So you buy your puts for the 31st and then you sell the calendar for the 24th. In this case, you're betting that, let's say in the downside, you're betting that UAL is going to flush down and let's say it goes down 10%. That's the bet. So you're going to buy the 100 puts. But instead of, but you don't think we're going to do that before the end of the week of the 24th. So you actually want to go a little below. You probably want to go to 99 or 98, but sake of argument here, let's just use the 100 for an example. What you're going to do is we buy the 31st and then you sell the 100 for the 24th. And that way you're spending 40 to have exposure in UAL. And the best scenario you can face is UAL goes down, but it doesn't close below 100 by Jan 24th. Then the trade becomes insanely profitable. You can go to 700, 600% worth of gains. So that's a trade that I think it's worth. But we have see a little bit of low volume. You're still going to get credit for it, though. There's another way you can play with this. What if we blast below 100 right away? I want to make some money. And if that happens, let's say UAL by Jan 24th is trading at 90, the trade is kaput, right? Because yes, you have money on the 100 that you bought for the 31st, but you're losing money at the 100 that you sold for the 24th. So one way to mitigate that is to go a tick below. In this case, you sell the 99 instead. And that way, if you see UAL at 95, for example, by the 24th. At least you spent 75, but you're making a buck, which is the difference between these two. So you're making about 25 cents. Makes you feel a little better that you walked out with a profit, even though you missed out on the massive move down. So there's a risk to it. If you think it's going to be a big flush, then this strategy will limit your gains. So that's the only downside with it. But boy, does it reduce your entry cost to an attractive level? Yes, it does. And we had some of those, by the way. We had some of those that played out before, and they played out handsomely. I'd like to buy. What do I like to buy for long-term suggestions? How do you see bond yields doing in the next few, let's say, weeks? So if we look at the weekly chart, look at what the market did on a mere pullback in the 30. But let's look at the weekly chart. Do we see it reversing or do we see us challenging the highs? My 2 cents would say as the new administration come in and we get the new policies, yields are going to head higher, not down. If that is the case, then that eliminates, if you look at the map here, that eliminates a huge chunk of the market that is dividend paying and value based, so you can't really buy those. There's no reliability in them. Okay, what do we do next? Can you continue to chase the big caps? Gotta wait for earnings. What? Gotta wait for earnings to give you a verification or not. A lot of them are already warned us that, hey, folks, the margins are not doing pretty good. With that being said, I think that you can still buy some of the stuff right here in semiconductors like AMAT, like Lam, because those benefit either way. I mean, they're not really worried about expansion of peaking revenue expansion because of the law of large numbers like NVIDIA, because they didn't rally as much as NVIDIA. And at the same time, if the orders increase by NVIDIA, they benefit. So maybe you'll add exposure if you must in the chips, if you need exposure to the chips, so you don't feel like you're missing out. Maybe you go with AMAT or Lam. In the designers, I think Marvell is the one that I would like. So Marvell is the one that I would buy because it is cheapish, not really cheap, but cheapish valuation-wise. I would not buy AMD. I would not buy NVIDIA. I would avoid Qualcomm and AVGO too. As far as software, I do like software. If you don't want to guess, just buy the IGV. I'm going to keep my exposure to the IGV. I think we got a nice correction here and shoulder, but I think we head back up. You see that sort of a cup and handle pattern, right? By the way, yesterday we talked about Nintendo, right? Nintendo with a cup and handle. Today, Nintendo went down, right? So it's giving you the opportunity to enter. Sell the news, right? Pump before, then sell the news down about 5-6%. So I'll probably buy a Nintendo on the OTC. Not the best exposure, to be honest with you. I mean, if you want to buy it, you buy it in the Japanese exchange, but this is the only avenue you can buy Nintendo by. So I'll buy it today, 2.5% dividend. So I'd add a position today, maybe incrementally add to it because I think that this pattern looks pretty good and will head higher again. And I think that, what is the upset about today? They say that they didn't give us the pricing and the details. They're going to do that in April. They said that. Today's just the teaser. or yesterday was the teaser. So in April, they'll give you the pricing and the details. I think it's going to be a big hit. If the economy doesn't collapse between now and then, it's going to be a huge hit. So, but anyways, we were talking about the IGV with a similar pattern. So I'll stick to the IGV if you don't want to guess and buy individual names. Although my favorite, Trade Desk, of course. So you'll add Trade Desk if you'd like. Give you a nice dip. I'll probably add shares today. You know why? Because we have this thing going on. We might break above. So, and you have that back D. Okay, so we'll add Trade Desk today. Nintendo, we'll add Trade Desk, and we'll add, let's see here. The other favorite name that I got is Now, but that's way too high. In cyber, I do like Okta. So Okta looks pretty good. We added to it and we'll keep it as it is. So Okta is another option. So even within technology, my friend, you still got options here to play with. And you don't have to chase the high flyers and the stuff that went crazy. You still got stuff that is heating up. Datadog, I'm seeing some good exposure in Datadog. So that could be one that went down and now it's ready to go higher, but I'd rather go with Trade Desk. It's more reliable. Now, by the way, are you guys with us here or am I talking to myself? Because we were doing a great discussion. This could be a video, by the way, that I'm doing right now. But I'm doing it in the live stream right away. So I hope that some of you are still with us here. Let's see. Yeah, we got a good number. It's actually increasing. We're getting more viewers. Okay, good. Let's continue this conversation here. On the banks, I'd avoid. I never liked the banks, and they'll be susceptible to any weakening in the economy. I would look at AXP maybe as an exposure to the short side once we see the market going down and weakening in the affluent consumer. AXP to me might be a shorting opportunity at that point, but right now it's way too hot, so be careful because it's way too hot right now with the affluent consumer dominating the economy. It's a huge rally, but I'm waiting for a shorting opportunity in AXP when the economy weakens. Would I add any long exposure? Maybe JPM will convince me at some point if yields keep going higher, but I'd avoid the banks. As far as healthcare, I do like names like Merck and Bristol Myers, Amgen, so I do have a lot of exposure in the big pharmaceutical companies, and I think that, yes, people worry about the new administration and what they're going to do, but they usually end up being friendly to big pharma, and they pay good dividend, good valuations, bond yields go down, you see these guys going higher. I'd avoid Lilly. I'm short Lilly, so that's sort of my hedge against my big pharmaceutical exposure. I have names like MDT in medical devices. I think that's doing pretty good, and it benefits when it got some good news recently, MDT. So let's see here. Yeah, I'm not sure what the news is, but there was a piece of news a few days ago. I forgot what it is, but it caused a pop in MDT. And again, good name to keep, pays great dividends. So if you look at the dividend here, 3.2. That's not bad, right? So MDT is a good choice. Striker might be, SYK might be something that is beginning to move higher. So you can take that exposure too in the medical devices. As far as the biotech, I'd avoid. Regeneron might be the opportunity, right? Regeneron might be the opportunity to buy, but it's still on the weaker side. It didn't reverse like the rest. But I would look at it as an opportunity if it begin to make higher highs. Maybe this report will do the job. We'll add Regeneron. I mean, I already have a Regeneron in my portfolio, but I'll add to it on the dip. Now, what else can we do here? We have here in the medical instruments, we do have RMD. That's the only one that I got. So RMD looks pretty good, right? All of these healthcare names appear to be doing this, right? They're heading down and they're ready to coil their way higher. So look at these names. ISRG was really, really hot, but I don't know if it pulled back enough. Yeah, it just keeps getting hotter, right? Every time this guy weakens, you find a buyer. So, but you see the opportunities here, right? So there's plenty of opportunities here in healthcare. Now, I do like the diagnostics too. So Thermo Fisher, I talked about that. So that's still, I mean, look at, since we bought Thermo Fisher, we already went to 560s. So I'll keep that exposure, maybe add to it at some point. So that's healthcare for you. Industrials. We're doing a whole portfolio review here, folks. As far as the industrials, I think that we're going to see some excitement because of Trump, and a lot of them went down significantly because of the rise in bond yields. So some of the names that I like, and I might add to those. Fastenal, obviously Fastenal got the earnings report and today, so there's a little bit of debate, but it seems like it resolved to the upside. So I got to look at this report, but if it is not bad, we'll probably add Fastenal. It's a miss though, so we got to be careful here. So Fastenal could be one. Emerson could begin to heat up, so we'll add Emerson today. We'll give you all of these moves by the end of the day here. We'll add Emerson. And then here, Deere. I do like Deere with the Trump administration and China stimulus. I do like Deere. So we were anticipating a pop here. We finally got it. So we'll do Deere. A little too hot today though. Yeah, a little too hot to chase. Caterpillar, not sure about that. Triple M, a lot of folks love that because of the dividends. So Triple M is another choice that you could add. Weekly chart, right? Consolidation if it wanted to go down, it had plenty of room to go down. But it's blasting higher and now bond yields down. So Triple M could be a good choice. I would not chase some of the high flyers. I mean, URI could be a case here for industrials. URI, big pop this week, but that's because dividends went down, short covering. So I got to see where bond yields will go before I make up my mind. I think they pull back again. I think bond yields rebound, so we have to be careful with those. Defense contractors also a favorite. So defense contractors, Lockheed Martin is now reversing, right? Coming back up from this falling wedge. Raytheon will be great under Trump, so you see a huge pop. Let's continue to add to that. Some names here eaten out of the void, but you have IR and you have ITW, so could be an opportunity. ITW Illinois could be also a reversal candle, so you can chase those. Waste management is something that I usually like, and we talked about buying waste management right here. We got cut loss, we traded above. With bond yields going down, all these names in industrials do pretty good, so you still got exposure in the industrials. Energy, I'm keeping my exposure right now with Exxon, Cameco adding the nuclear, and Valero, the refiner. I wish I kept my Coterra and EQT, but I did not. So we might add some LNG exposure, because after the rally in nat gas futures, now you have to ship them, right? You see demand increasing, you have to ship them. So Cheniere, I mean, it's been exploding higher, but it could continue to move higher. I don't know if I would buy it right here, though. It's way too high. So, but we'll look at a nat gas play. Maybe Kinder Morgan. Kinder Morgan pays a good dividend. All of them are hot, but Kinder Morgan is a reliable player here. So if it dips based on this earnings report, I'll be a buyer. And Kinder Morgan pays almost a 4% dividend. So you see, there's plenty of really good long opportunities in the market if you still want to have exposure and add. Utilities that avoid, the CEGs of the world, they'll be really volatile. The one that I got, you can go with Duke Energy. So I like Duke, I like Dominion, either one. They pay good dividends. So in the case of Duke, which I think is a little bit more reliable than Dominion, pays about 3.8. As far as the metals, I think if the dollar pulls back, they'll be hot. So we'll add to the SLX. We'll keep Freeport. We'll have some exposure here in Corteva, but it'll probably begin to add to the fertilizers, like Mosaic. Probably add to that because that's beginning to reverse. So we'll add Mosaic before the end of the day today. So we'll do some shopping here before the end, folks. And then if we look at the staples, that's a risky corner because if yields come back up, that's going to be tough. You look at names like Philip Morris, was a performer, then yields came back up, and I think that yields will go higher. So the only one that I would do is probably after the report, I would add Procter & Gamble. I have a position already that I bought right here. I'll be adding to it again. I got the puts also that protected me from the drop. We shared that in the program before, but we'll add to it right here because after this report, because I think Procter is more reliable than, let's say, Philip Morris or the stuff that is really reliant on bond yields to go down. So here, not as many opportunities. Anything in the cyclicals. We talked about TG Maxx, right? That could still be hot. Automobiles that avoid, with exception of the Chinese automakers. I would add exposure to China, Alibaba, Pinduoduo, JD, whichever one you like. As far as the travel stuff, the cruises, I would look for them as a shorting opportunity at some point. McDonald's could be interesting, but again, not a lot of opportunities here in the cyclicals. Not a lot. The casinos could be actually a short at some point because business is weakening in Las Vegas. As far as telecoms, the last sector. Can we add something here? Exposure to Netflix? No, I'm actually waiting to short Netflix, to be honest with you. Not because I think that they're bad or anything, but because it just went way too high. I'd love to capture some downside momentum as a correction to the 700, 600, but that's going to be in time, not right now. Disney is something that folks are really excited about right now, so Disney could be the streaming growth, keyword could. I mean, Disney always disappoints, but dividend is 1%, so let's see Comcast. What would Comcast do? Comcast on the weaker side, but it might be an opportunity here. I'd avoid it though. It's not the best. I'll keep my exposure at Verizon. Add to Verizon. Maybe, the telecoms, Take-Two because of Grand Theft Auto. That could be a catalyst. So you can add Take-Two, but it's already way too hot. You got a sort of a bearish candle here, so I'd wait for this report to come out. Maybe we'll get the details about GTA when this report comes out. If that is the case, we're adding Take-Two. But you can see that there is there's a lot of stuff that I still like in the market here on the long side. And we covered all sectors right here, folks, in a live stream. Imagine that. So I just gave you ideas here, my friend, of what I like in the market, what I'm going to be adding to in my exposure. And of course, we'll also have shorting opportunities. So at some point in the banks, we'll do NVIDIA and the big caps, obviously, if we get the reports. And then we'll see also shorting opportunities in the cyclicals later on in the cycle. So one step at a time, but this was a really good discussion. Let's go back to the market here, folks. Okay, OCK Cult, I hope that I answered your question. I'm still keeping DELL short shares. What is your plan to cover them? 80 is a good level for that. So if we look at DELL, I'm still short. I'll continue to keep my short. Let's go to the weekly here so we can see it better. It looks to me like a bear flag that's playing out already, right? So when do we cover? I'd love to go down here to the 61.8 retracement. So it'd be around 65 or 75, 80. Yeah, that'll be a good place to cover. But to be honest with you, the nature of these bubbles, when they break down, all of them do this kind of look, and then they retreat, make a lower high, and then they frizzle back and they trade where they were trading before the bubble. So you'll see DELL back at the 40s again. But that could be a long time, could be 25, 26 before you see that happen. But again, the majority of the expansion is because of a bubble, an increase in demand and pricing. That stabilizes over time. It ends the bubble, and then we see maybe that the revenues are normalizing back to where we were before the bubble. So, but right now, to be reasonable in a downside target, yeah, 75, 70, 80. To me, that would be a reasonable target. At that point, at least, I'll be selling some puts as a hedge, covered puts at that point. The only problem that I see, to be honest with you, is I'm looking at this move today, and I'm thinking if we begin to trade based on this impression, the mistake that we could do is we could assume that we're going to go higher. And all what we've gotten so far is three things. Inauguration optimism, which is going to be short-lived. OpEX, that could reverse by Monday. We see a different dynamic. And the pullback in yields that led to this rebound. And if these things reverse, and as we see already kind of bond yields finding a footing, I'm afraid of opening trades right now being influenced by the bias of let's do more calls this time around because we're going to go higher. And next thing you know, we pull back. So I think that for the February set, I think we need to see a little bit how's that going to resolve here. And the end of the day will be important, the end of this session. And then, of course, Monday, Tuesday, after we come from the holiday, I think that's the point where we will have more clarity.